The latest economic report said that our economy grew in Q3, meaning that we're not in a recession, but that doesn't mean that we don't have any economic pain ahead. A recession has traditionally been defined as 2 quarters, aka 6 months of economic slowdown. And in the first quarter of 2022, we saw our economy slow down. And in the second quarter of 2022, we also saw our economy slow even further. After we saw those 2 quarters of economic slowdown, which was the traditional definition of a recession, we saw a lot of people like the President and our Treasury Secretary and the Federal Reserve Bank argue that this was just a temporary economic slowdown, so it's not fair to call it a recession. The National Bureau of Economic Research is the entity that declares if we are in a recession or not, and after hearing these claims, they declared that we were not in a recession. Then in the last few days of October 2022, we got the third quarter economic data, which said that our economy not only grew in the third quarter, but it grew much faster than expected. And that report essentially negated all recession talks. But the recession story doesn't end there. In a normal economy, a strong economic report like we just saw would be great news because it shows you how fast our economy is growing. But we're not in a normal economy. In a high inflationary economy like the one that we're in right now, a strong economic report means that there's more room for quantitative tightening. In other words, higher interest rates. You don't have to look very far to understand the impact of higher interest rates on the economy. I mean, you can look at the housing market, or you can look at techie growth type companies on the stock market, because these are companies that have been relying on low interest rates for a long time. Some of the biggest companies in the world are tech companies, and they were hit especially hard by the impact of higher interest rates. Just take a look at Amazon, take a look at Meta, take a look at Microsoft, which were hit very hard by inflation and the effect of higher interest rates. By definition, we are not in a recession yet. Hate it or love it, that's the definition. Now, if our economy continues to slow because of higher interest rates, and then we enter a recession sometime in the future, well, that's when the National Bureau of Economic Research will backdate the recession to when the economic slowdown started. The Fed essentially has 3 options when it comes to interest rates in 2023, 2024, and beyond. They can raise interest rates as a way to continue fighting inflation aggressively. They can keep interest rates at where they are as a way to hope that it'll keep fighting inflation. Or 3, they can cut interest rates as a way to stimulate and boost the economy. If they do this one or this one, chances are we're going to enter a recession sooner rather than later. Now, of course, nobody can predict what the Federal Reserve Bank is going to do in 1 month, let alone 6 months, let alone 24 months. And so this is where you don't want to be trying to predict what the Federal Reserve Bank is going to do, but rather understand how to use your money the right way. And I think the best thing that I can do is maybe give some insight on things that I'm doing as a business owner. Because I run a company called Briefs Media. We are a financial newsletter company. We also have a business newsletter called Business Briefs, and I am preparing for a recession. The way that my company works is we have free newsletters, which we have advertisements on. So we have a newsletter for investors called Market Briefs, and then we have a newsletter for entrepreneurs and business owners called Business Briefs. And these newsletters are completely free for our readers. They're jam-packed with value. And then our biz dev team works to sell advertisements on our newsletters. And in the last few months, we've been seeing advertising revenues fall because less and less businesses are interested in spending money on advertisements. We're not the only ones. Ad revenue has been falling for a lot of major companies across the board. Now, I was too young to actually remember or pay attention to what happened leading up to the 2008 crash. Plus, I didn't really care about business or finance back then. I was in high school when the 2008 crash happened. But in some of the books that I've read, what they said is that in previous crashes, advertising and marketing are the first divisions to get cut when you see an economic slowdown, and that includes 2008. I'm not scared of a recession happening. I'm prepared for a recession happening. We've been putting cash aside. We've been making plans that if we do see an economic slowdown, what will we do to, 1, protect ourselves and our company, and then 2nd, to take advantage of an economic slowdown that might happen from our business perspective. So I'm not scared of it happening. I've been working to prepare for it. Now, you don't have to listen to me, but this is where I want you to understand what are the different possibilities and what's the worst case scenario if you're prepared and if you're not prepared. On a very broad and basic level, we have essentially 3 different outcomes of things that can happen not just in 2023, but into 2024 and even beyond that. We could have no recession, we could have a mild recession, or we could have a deep recession. If we have no recession and you are prepared for a recession, well, then the worst thing that can happen is now you take this extra cash, you invest it, or you go to Disney World. If we have no recession and you're not prepared, well, then nothing bad happens. So if we have no recession and you're not prepared, no big deal. And if you're prepared, again, no big deal. If we have a mild recession and you are prepared, well, then you'll be able to take advantage of some opportunities that come your way. And if you are not prepared for a mild recession, then you might go through some economic pain, or you might just miss the opportunity to take advantage of some great investment opportunities. So if you're not prepared and we have a mild recession, well, you lose out on some opportunities and you might see some economic pain. But if you are prepared, then you can take advantage of opportunities. If we see a deep recession and you're not prepared, well, now you're going to not only miss out on economic upside by missing the economic opportunity to invest, but you're also going to go through a lot of economic pain. This is what we saw happen in 2008. If we see a deep recession and you're not prepared, well, now you're the one that gets burned, you're the one that loses, and you're the one that has to go through that pain. And you also miss the opportunity to take advantage of opportunities when you have a deep recession. Like in 2008, the stock market got sliced, real estate prices got slashed, and they created opportunities for investors who were prepared. Likewise, if you are prepared for a deep recession, well, that means now not only can you protect yourself, but then you can take advantage of opportunities that might come your way. So just by these factors, if you are prepared, your downside is none. But if you're not prepared, your downside can be none or very great. So it makes sense to prepare just in case of anything. This is such a unique opportunity now because unlike previous crashes, except maybe 2020, there was no financial education that was readily available. Like YouTube was not the place to go to learn about money back during the 2008 crash. There was no YouTube during the 2001 dot-com crash. This type of education was not available then, but it is now. And this is where now regular people, for the first time really ever, have the opportunity to know what to do and actually take advantage of opportunities if you are prepared. Now, if you want to stay up to date on what's happening, if you're an investor or if you're a business owner, you can join market briefs for my investors and business briefs for our entrepreneurs and business owners. I got both of those links for you down in the description below. But this is where now you want to be working to be prepared on one hand, meaning you're working to live below your means and potentially make some more money. That way you have a cash buffer that you can put aside so you have cash to take advantage of opportunities and take care of yourself. But this is where you also want to be financially educated. Understand what's happening. Understand where the opportunities are, because the opportunities constantly keep changing. I mean, you saw in this video how some companies, some great, very powerful companies have been getting hit hard by the market. These things create opportunities because if a company gets overly hurt, it becomes undervalued. Well, that creates an opportunity for you to come in and buy the asset at a discounted price. And then as the economy turns around, well, then now you can ride up the wave. But you have to be able to have access to cash to actually make an investment, whether it's in stocks, whether it's in real estate, maybe it's cryptocurrency, maybe you're buying a whole business. But you also have to be educated enough to know what to buy. So the Fed right now is raising interest rates because they want to slow down inflation. So when you raise interest rates, what happens? It's more expensive to buy a home now.
So less people buy.
Less people buy. Less cash enters our economy, less institutions borrow money, less corporations borrow money. So borrowing goes down, less dollars enter our economy. The second side is